Hi everyone, welcome to today's webinar with me, Fawad Razakzada, market analyst with Think Markets. So today I'm going to be doing this alone. My colleague Victor he's still on holiday. He should be back within the next week or so. So our regular weekly webinars that are happening on Tuesdays should be with him starting possibly from not next week, the week after. Anyway, welcome to today's webinar. For those of you who have joined us, please make sure to ask me questions during this webinar, or you can wait until the end of the webinar when we'll have a Q&A session. And for those of you who are watching a recording of this, it may be a bit late. By the time it's up on YouTube, the jobs report may have already been out. But you might want to join us for that reason. You might want to join us live next time because obviously we try to provide a preview for the jobs report in this webinar. So it's basically divided into two parts. We look at some of the pre-NFP leading indicators to try and come up with a rough idea of how the headline jobs number may look like. Will be all about technical analysis of a few major currency pairs, gold and indices, in order to provide some actionable trade ideas after the jobs report is published. My internet connection is a bit slow today, guys. So if you can't hear me, please let me know in the questions box or in the chat window. So yeah, let's begin then, guys. And before we do that, read the first paragraph of this risk warning or disclaimer. I'm going to help you by reading it. These webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think Markets shall not be responsible for any loss that you incur, either directly or indirectly arising from any investment based on any information in this webinar. Please remember that spread betting and trading CFDs carry significant risks and may not be suitable for all investors. So yeah, I already told you the agenda for today's webinar. No need to look at that slide again. So why is the jobs report so important for the markets? Well, the non-farm payrolls report has traditionally been one of the most eagerly anticipated macro events for the markets. This is because one of the Fed's mandates is to maximize employment. The other being, of course, to keep inflation around the 2% average target. Inflation is obviously well above that target at the moment. So tapering is the buzzword, if you like, right now, because investors are guessing as to when the Federal Reserve will normalize its policy, because, as I mentioned, inflation is already well above the target, and there's a risk that inflation could accelerate further and remain at uncomfortably high levels for a sustained period of time. So the Fed is just waiting for employment to improve a little bit further before it starts to reduce the pace of its asset purchases program. Now, the US economy has recovered really strongly from the pandemic, although in the eyes of the Fed, not so strong to warrant a monetary policy response. Well, not yet anyway. With some 6 million jobs, 6 million or so jobs still needed to reach the pre-pandemic levels, the days of inaction by the Fed are numbered, I think. So taking everything into consideration, today's non-farm jobs report will probably trigger a strong response by the markets, especially if we see a massive beat or massive disappointment. In terms of expectations, well, after rising by 850,000 in June, following 2 months of disappointing readings before that, economists are expecting another solid showing in employment for July, with the headline jobs growth coming in at 870,000 for the month. So that's the headline expected figure, 870. Meanwhile, the unemployment rate is expected to have fallen to 5.7% year over year from 5.9% previously. In terms of wages, the analysts similar to the previous month. So will these expectations be met or missed? Is the Sorry, guys, I think I lost you there for a minute. I hope you can all hear me loud and clear. So the key question is, will these expectations be met or missed is the key question. And more importantly, how will the markets respond? So overall, I think the headline jobs data may come in a little bit weaker than expected because of the mixed pre-NFP leading indicators that we have had this week. Most of the indicators suggest that the jobs report will reveal another solid performance, but the ADP private payrolls data, which admittedly is not a very reliable NFP indicator, came in quite weak on Wednesday at 330,000 versus 680,000 expected. But this was obviously countered by strong showing from employment components of the ISM services and manufacturing PMIs, which tend to be more strong indicators for the official jobs report. So the ISM services PMI, services is the largest and the most dominant sector in the US economy. The fact that the PMI rose to the fact that PMI rose above 50, which is the threshold between boom and bust, is a positive sign anyway. But the fact that it beat that last month's number by 3 whole points is indeed a good sign. Likewise, the manufacturing PMI employment component came in about 4 points higher than the previous month. Meanwhile, the latest weekly jobless claims data showed that the number of people applying for unemployment-related benefits dropped close to a pre-pandemic low, I should say, suggesting that the Delta COVID variant has had minimal impact on the economy so far. So whatever the headline jobs data may be, don't forget to take into account the average hourly earnings figure to gauge the health of the labor market, and more to the point, when deciding on a trade. So, moving on to the trade ideas, then there are obviously various scenarios that could play out depending on the outcome of the jobs and wages data. Assuming that the wages is in line with expectations, concentrating on the headline NFP, we will have 3 basic scenarios, right? So the first scenario is that NFP will come in really strong. The second scenario is that it will come in really weak. And the third scenario is that it will be somewhere in between those 2 extremes, around in line with expectations. So taking those 3 scenarios in turn, then to come up with various trade ideas. If it comes in stronger than expected, I'm talking about like a million plus on the month, this will be really strong. It will be a very bullish sign, I think, for the dollar. So in that case, we could look to go long the dollar against some of the weaker currencies like the euro, maybe. The European Central Bank is one of the most dovish central banks out there at the moment, and the euro dollar continues to struggle. Each time it tries to bounce back, it keeps getting slapped back down. So going long the euro dollar, going short the euro dollar. So going long the dollar against the euro, meaning shorting the euro dollar, could be an idea if the jobs report comes in well above expectations. Gold is struggling as well. It's had numerous attempts to break out. Each time it gets slapped back down because of investors' appetite for risk. Equity indices in the US remain near record highs. In Europe too, the major indices have repeatedly hit new all-time highs or multi-year highs. In the case of the German DAX, in the case of the French CAC index. Not so much for Spanish IBEX, but that index could be about to stage a breakout as well. All the major European indices have been climbing higher because of the fact that the European Central Bank is one of the most dovish central banks out there, and is continuing to provide lots of liquidity for the markets. So for that reason, investors are continuing to pile in the equity markets because they are rising more rapidly than anything else at the moment. So there's less demand for safe haven gold at the moment, which is why, despite the lower yields across the board, we're not seeing that response in gold that you would normally expect. So if the jobs report comes in stronger than expected, then we may see gold continue to struggle, and it could be headed lower. In contrast, however, speaking about gold, if NFP disappoints really badly, then with yields already being low, and the fact that the and the potential for the dollar to weaken, some key support levels, as I will share with you in a minute or so. In terms of the other scenario, NFP coming in line with expectations, I think this should keep the stock market supported, because it will keep the Goldilocks scenario intact for equity investors. So on the one hand, improving economy is obviously good news for stocks. On the other hand, a slight improvement in jobs growth will not cause the Fed to taper its purchases sooner than expected. So that should be positive news for stock markets, and it may also keep risk-sensitive markets supported, such as the pound against the Japanese yen, etc. Let's now focus on technical analysis and look at a few charts. Now, I mentioned the euro dollar, and if you look at the euro dollar chart, it has struggled this week. This is the weekly time frame. Last week it rose, but now it's gone back down. It's still kind of clinging on to the bullish trend line, but it's looking quite weak, and I wouldn't be surprised if it were to break down decisively on the back of a really strong jobs data today. However, there are a couple of levels to watch on the downside. 1750 is potentially a strong level of support, because the euro has bounced on a number of occasions in the past. So keep an eye on it, on that level, 1750. What am I doing? 1750. Below 1750, there's not much further support seen until 1700, which is where the euro had previously found some support in the past. But all told, it's looking quite weak, the euro. So I'd be more inclined to look to sell into any potential reps than buy the dips in this market. So one such level could be yesterday's low at 1828, call it 1830, which is now broken, obviously. So a rounded retest of that level, provided that the jobs report is not too weak, could offer some resistance after the jobs report is published. So those are your key levels of support and resistance to watch. Beyond 1830, I would be looking at 1900, I think, because that's where the euro has because that's where the euro has struggled in recent times, as you can see by the wicks of these candles. So that's the next key level of resistance to watch on the upside. I think the upside will be limited, even if the jobs data disappoints really badly for the euro. Now, if you want to play the potential weakness for the dollar, you may as well choose a stronger currency. So, for example, if you look at the pound, let's have a look at the pound against the euro to give you an idea how strong the pound is at the moment. Now, this is the pound against the euro. You can see that it has been falling, meaning that the pound has been gaining strength against the euro. Therefore, if you expect the dollar to weaken after the jobs report is published, then looking for a long setup on the dollar, on the pound against the dollar, would make more sense, wouldn't it? So I have drawn a couple of scenarios here for you on this chart. This is the daily time frame. Obviously, you can look at your intraday charts for more precise levels, but right now that the cable is in no man's land, really. It has been supported by a slightly hawkish Bank of England and macro data showing the UK economy is improving sharply, suggesting that time for a lift-off in rates is getting closer and closer in the UK. On the other hand, the stronger US dollar is capping the upside for this pair. So while it is in no man's land, you could wait for price to break out in a particular direction and then trade it in the direction of the breakout. So on the upside, what I would be looking for is a clean break above 39.60 to 39.80-ish. A clean break above that level could obviously initially target 140 psychologically important level, but it could go a lot higher than that with the 78.6 coming in at 141.05. That could be the next target. However, if the cable breaks down, say because the jobs report comes in really strong, then in that case, I would be waiting for a clean break below support in the shaded region in blue, and then I'll be looking to sell the retest of that area from underneath. Yeah, so those are the potential scenarios that I would be looking out for insofar as the cable is concerned. Other currency pairs are showing very similar price action to the euro and the pound. Let's just quickly go to the chart of gold, because gold has really struggled in the past. I thought it might be about to stage a breakout last week when bond yields fell further. Let me just show you the bond yields chart. This is the 10-year US yields. Yields have been falling, but on Wednesday, yields bounced back really strongly because one of the Fed officials said that the conditions are improving and that policy tightening could be around the corner, etc. Caused the yields to bounce back across the board. And we've since heard from the Bank of England, who also sounded a little bit more hawkish than expected. And you can see here that the UK bond yields also bounced back. So when yields go up, typically this is not good for gold because the opportunity cost of holding gold rises when yields climb, because gold and silver, they don't pay any interest or dividends and cost money to store. So investors, when yields are rising, they don't like to hold gold or silver. So for that reason, gold has fallen back, and it couldn't hold the breakout above the 1810 support level as I had envisaged it might. So the 200-day average is offering additional resistance. It has tried to climb above the 200-day average for several occasions in recent times. It has failed. So price action is looking quite heavy on gold. Therefore, if you are expecting a really strong jobs report today, shorting gold makes sense. While the only reason gold could go up today, in my view, would be if jobs data comes in weaker than expected, or for whatever reason, bond yields fall back. So tactically, if you are bearish on gold, then you wouldn't want to see gold go back above the trend line. Okay, so that would be your invalidation level, if you like. In terms of targets, well, 1790 is very close. It's where price has previously bounced from. That could be the initial target, ahead of the retest of the right shoulder area at around 1765. That could be the next downside target, but potentially could go further lower over time before it makes this next move. If you're bullish on gold, what you would like to see first and foremost is a rally back above 1810, which has been a pivotal level in the most recent times. Ideally, you'd also want to see a breakout above the bearish trend line as well. Yeah, because right now it's making lower lows and lower highs. So you'd want that trend to break down before looking to buy gold because you want to go with momentum, right? So at the moment, you don't have that bullish momentum in gold, which makes it a ideal candidate for the shorts rather than the longs. What else? Let's talk about indices very quickly because I mentioned indices are at record highs. So if you look at the S&P 500, index futures are suggesting a fresh record high for the S&P 500. And it's continue to make higher highs and higher lows. There's no point of fighting this trend, yeah. But if you are already long, the equity markets or one of these indices, then perhaps lightening your position a little bit may make sense, because say if we get a really strong number, on the one hand, it would be positive for the stock markets because obviously a strong and a stronger economy usually means stronger profits for companies within the index and so on, and higher share prices. But the flip side of that is that if the economy is overheating, the Fed will be more inclined to reduce its asset purchases sooner than expected. So in the event we get a really strong jobs report today, paradoxically, we may see the S&P 500 and other major US indices come under pressure. So watch out for that possibility. However, if it's in line with expectations, the jobs report, or slightly weaker, then we should see the Goldilocks scenario intact, and we could see further record gains for the S&P 500 and other major US indices. Now, it's, from a technical point of view, it's making higher highs and higher lows above the 21-day exponential. So the trend is clearly positive, and the S&P has consolidates. Usually, when it consolidates below resistance for a number of days, it usually breaks to the upside, because it indicates that resistance is not strong to cause the market to reverse. So from here, it looks like the market wants to push higher. And if you want to draw your Fibonacci extension levels from this swing to here, you can see that we have the 127.2 coming in at 44.36, followed by the 161.8 extension at 44.91. Those are the next Fibonacci-based objectives for the S&P 500. I mentioned European markets just on a side note, because some of you guys may want to avoid the NFP or US-related markets altogether. And if you look at the European equity indices, this is the Europe stocks 600 index. So it's the largest 600 stocks in terms of market cap in Europe, including in the UK. And if you look at this index, it's been climbing higher and higher every day in the last in the last few weeks, and hitting repeated new all-time highs, suggesting that sentiment towards European stocks is improving sharply. And this is all to do with the fact that the European Central Bank is continuing to buy government bonds, driving yields lower. If you look at the German yields, they fell to negative 0.5% this week. German yields remain the lowest among the major economies. Let me just show you a comparison chart very quickly. There you go. So if you look at bond yields, 10-year bond yields since they peaked in around middle of May, you can see that German yields continue to remain under pressure. And Germany is in the bottom of the yield chart when compared to some of the other developed economies. So the fact that yields have fallen, this makes European equity indices more appealing for investors. So one of the indices to look out for, well, I was going to say the German DAX. It's about to break to a new high because, you know, this inverted hammer candle didn't work out for the bears. So it looks like the sellers are trapped. So for that reason, I think it's very likely that DAX will take out its previous all-time high. But keep an eye on the Spanish IBEX, because this index has been underperforming Europe. As you can see, it hasn't even taken out its February 2020 high. But in more recent days, it's been coiling for a potential breakout above this resistance area, which it is trying to take out today. So we could well see renewed strength come in on the Spanish IBEX. Obviously, Spanish stocks have struggled in part because of the fact that the Delta variant of the COVID has caused travel and tourism to remain a little bit weaker than people had hoped previously. I can see a question. Shouldn't the euro price affect European stock? It does. So when if you think about the German economy, is the German, because the German economy is the largest in the eurozone and is the economic powerhouse, right? So the German economy is a export-oriented economy. It produces nice cars, among other things, you know, BMWs, Audis, etc., etc. It exports to the US, to China, and many other places around the world. So what the Germans want is a weaker exchange rate. So the fact that the euro dollar has been most other major currencies, this is good news for Germany, because it makes their exports cheaper to the rest of the world. Likewise, people coming to Europe for holidays will like the fact that the euro is a little bit weaker, because they can buy more euros with their pounds or with their dollars, and enjoy and spend more in the eurozone. So the fact that the euro has weakened is positive for the European stock markets. And so should today's jobs report in the US beat expectations and causing the dollar to rally further against the euro, then this should be further positive development for the European equity indices. May I know US 30 is another question. Of course, US 30, aka the Dow Jones, is testing record highs. It has been consolidating for the last several days, but if you look closely, consolidation has been near record highs and previous resistance around what is it called? Around this level right here. So it looks like the index is gearing up for a potential breakout to the upside, and it may have started that motion already today. I think it needs well, the Dow contains lots of value stocks as opposed to growth stocks that are dominated in the technology sector in the Nasdaq. So when the economy is expected to do well, when you have stronger data coming in, usually you will see value stocks, those that rely on strong economic performance of the economy, they will tend to outperform. So today's jobs report is going to impact the Dow, obviously. If we get a stronger report, I think this should cause the Dow Jones to break to the upside. If we get a weak number, I think a weak number is not going to cause too much of a damage unless it's really, really bad, like, low 100, something like 100,000 or 200,000. That might really disappoint the market and cause the Dow to slump. In any case, from a technical point of view, it looks like it wants to break higher. So the next level to watch would be the previous record high at 35,200 or so. That was hit on the 2nd of August. So people who are short the index will have placed their stops above that level. That could be the next objective for the bulls. Beyond that, you could draw your Fibonacci's. Now, I would use this latest drop. So use it to plot my Fibonacci extensions from this high to this low. And there you have the Fibonacci extension levels drawn on the chart automatically for you. So those are the Fibonacci based objectives. Now I like to use Fibonacci extensions when a market is trading at record highs, because you don't have prior price reference points to get your targets. You could also draw your Fibonacci's from this high, connecting it with this low, providing you some alternative Fibonacci-based levels to keep an eye on. But keep it simple. Just use one. It doesn't matter which one is. It all depends on your entry and where you stop might be resting, etc. In terms of invalidation levels, I would say this level right here is going to be important. That at 34,725. This was this week's low. So you don't want the index to go below this level, because you know, as you can see, it has had a couple of attempts to break down here in this particular zone, but each time the 21-day exponential has provided some support. So ideally, it shouldn't want to go below this level again. If it does, we may see a deeper correction. But the line in the sand is this level here now. It's way down below market, but that was the last low made prior to price making or prior to the index making a record high. So unless that level eventually breaks, even if we see a short-term dip, it will not necessarily mean the end of the bullish trend, because it could be a deeper retracement inside what is a strong bullish trend. Okay, so the line in the sand is way over here for me. HH Hassan, shouldn't the euro price? Okay, I answered that question. What values would you give for high and low? I'm not sure which. I'm not sure what if I understand your question correctly there, HH Hassan. So if you would like to clarify, I'll wait for your response. Meanwhile, guys, if you have any further questions, this is your time to ask me now. Oh, for today's figures, okay. So HH Hassan says, what values would you give for high and low for today's jobs numbers? Well, if I go back to the slides that I shared with you at the start of the webinar, expectations are centered around 70,000 for non-farm payrolls report. 870,000. So for me, anything above a million mark would be very strong. Yeah. In terms of the low, I would say anything below 400 is going to be weak. But anything in between that, it's going to be met with mixed reaction in the markets, or not so significant reaction in the markets. So those are the two extremes I'm looking at for. Really strong would be above a million, and really weak would be 400 in my view. I hope that answers your question. I cannot see any further questions, which means that you guys are happy for me to conclude the webinar. I'm back on Tuesday when I'll be doing my regular webinars. So if you go to Think Markets, you can join me for the regular Tuesday webinar, which is a live session. And in that webinar, we discuss technical analysis, similar to the second part of this webinar. And you can register for that by going to our website, go to Market Analysis, then click on Live Webinars. And here you will see the link to register for that webinar. And this is it on 10th of August. So you click on register, follow the instructions, and you'll get an email with the link sent to you. Thank you so much, guys. Be careful out there. The jobs report is going to impact the markets, and we should see heightened volatility around the time when the data is released. Make sure you have appropriate risk management strategies in place. Keep your positions light, your stops widened a little bit, maybe, if you have to hold over the data. Otherwise, it's best to wait for the data to come out and then trade the reaction based on the outcome of the data. So I'll see you guys on Tuesday. Take care now. Bye-bye.